Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Goldman Sachs Real Estate Finance Trust. It's got some twists and turns, kind of like finding out your sure thing investment is actually a timeshare in Antarctica. You think it sounds great at first and then things just turn south. That is a joke. It's actually about stock sales and distributions. Basically, we are going to look at how they're selling companies' stock and how they're paying out dividends, focusing on the money side of things, how much they are giving out and who benefits most. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these filings with other investors. This report is called an 8K and it's basically a snapshot of important events that the company wants to tell its investors about. The date of the report or when the earliest event happened was July 1st, 2025. So everything we talk about today happened around then. One of the main things in this report is that Goldman Sachs Real Estate Finance Trust sold some of its own stock. These weren't your everyday stock sales on the stock market. They were unregistered, meaning they didn't go through all the usual checks and balances required for public offerings. They sold these shares through what's called a private offering. Think of it like selling your car to a friend privately instead of putting it up for sale at a dealership. Now, the company says that they were allowed to do this without registering the shares because of a rule in the Securities Act of 1933. Without getting too deep into the legal details, this rule allows companies to sell stock to certain kinds of investors without all the red tape of a public offering. The company relied on the buyers confirming that they were accredited investors, which means they have enough money or experience to handle the risks. Here's where it gets interesting with the numbers. They sold two main classes of stock class I and class S common stock. Remember that the company notes that these different classes are really part of the same kind of stock. Let's break down just how much stock was sold. They sold 372,406 shares of Class I common stock. In return, those sales brought in about $93 million. Wow, that is a lot. They sold another 48,573 shares of Class S common stock this time, bringing in around $6.2 million. Now, it's important to note that this amount includes some fees they paid around $50,000 in selling commissions. So why does all that matter? Well, selling stock gives the company more money to use for its business, like buying properties or paying off debts. It also means that there are more shares of stock out there, which could affect the stock's price and how much, say, each shareholder has in the company. Now let's move on to the next big thing in this report, distributions. Distributions are like dividends. They are payments the company makes to its shareholders. Think of it as a thank you for investing in the company. The company announced that around July 10, 2025, they'd be paying out distributions for the previous month, June 2025. The amount each shareholder gets depends on the type or class of stock they own. Here's where we see who gets what. The gross distribution, or the total amount before any fees, is about 16.5 cents, $0 some shareholders have to pay a distribution fee, which reduces their payout type. For example, if you own Class S common stock, you'd get 16.5 cents per share to start with, but you'd have to pay about 1 3/4 cents, $0 or 148.5 in fees, leaving you with a net distribution that is the actual money in your pocket of about 14 3/4 cents, $0 or 175 of in fees. So you have to pay a distribution that is the actual money in your pocket of about 14 3/4 cents, error 148.5 per share. On the other hand, if you owned Class I common stock, you get the full 16.5 cents because there are no distribution fees that you have to pay. The non-voting common stock and Class FI common stock have the same 16.5 cents with no fees. This means that some investors get more than others, depending on what type of stock they own. So, why does this matter? Because these distributions are how the company shares its profits with its investors. If you're a shareholder, this is the money you get back for putting your money into the company. It's also a way for the company to keep investors happy and attract new ones. The company wants you to keep coming back. To get these distributions, you had to be a shareholder before June 30, 25, otherwise you wouldn't get the distribution. Also, if you don't want cash, you can reinvest the distributions by buying more stock in the company. Now, overall, what can we tell from this report? Well, Goldman Sachs Real Estate Finance Trust is actively raising money by selling stock, and they're also rewarding their investors with distributions. The amount of money these activities is big, so it matters. One thing that might raise an eyebrow is the difference in fees between different classes of stock. It would make you wonder, why are some investors paying fees while others aren't? Is that fair? Also, by selling stock, the company is making more money, but existing shareholders could see their ownership and influence decline a little bit. Looking ahead, it'll be interesting to see how the company uses the money they raised from these stock sales. Will they buy more properties? Will they pay off debt? And will they keep paying those distributions to keep investors happy? Also, depending on the stock, the distribution is different. Alright, that's our breakdown of Goldman Sachs Real Estate Finance Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.